Right. I think we're off and running. Mate, good to see you. How things going?
Good to see you, man. Things are good. Things are well. How are you?
It's another day in the prison colony. Weather is good, some other things not so good, but that's how it is. Another
Yeah,
year
well,
in markets.
I feel the same way. It's the other side of the same coin, though, just with negative temperatures.
Yeah, it could always be worse, couldn't it? All right. So this year we decided to do a bit of an end of year recap. I think that was your idea and a pretty good one. I've had a bit of fun doing podcasts before, but it'd be good to chat a little bit more focused with someone who thinks along the same. I think we pretty much think along the same kind of lines. So this might turn into a yearly tradition.
Sure, yeah. Who knows where it goes?
Onwards and upwards on the podcast grind. So
That's right.
I think before we get started, it'll be good to do a little bit of a background. We did a bit of an around the grounds on Twitter and in DMs, etc. Questions that people had. So we've got like a lot of market and investing questions. We've also got some newsletter specific questions, which were mostly mine. I think the way we'll run through this is we'll run through some of the questions together. Some might be a bit more focused towards use, might be the other way, and we'll just roll from there. But before we get started, quite a few people asked me if you could go over a little bit of your background and how you came to investing, and perhaps how you came to be interested in the corner of the market that you are, specifically in the biotech and life sciences space.
Yeah, sure. So I've been investing in the capacity I've been in for quite a long time. I'd probably say I really started investing when I was very young. I think of like age of 12. I remember the first stock I ever bought was ConocoPhillips, and I sold it for a small, tidy profit. And this was at a time when there was no, I mean, online brokerages they existed, but they were not and especially in Canada, they were not as widespread. So you had to like call a guy or put an order through email or something like that. Developed initially, my style was very much Buffett-esque, like very much quality focused, larger companies. I vividly remember buying Nike in 2009, right during the great, GFC. Over time, it started to get more, as I've gained more experience and learned more, expanded my education. It's gotten far more Munger-esque, I would say, much more concentrated, best ideas, very IRR focused. And so now I would describe my style as I'm like an IRR hunter trying to find the ripest fruit from the tree, and that's sort of like how I've grown to be that way.
Nice. And like on the life sciences and biotech stuff specifically, how did you come to, and how long have you been doing that for?
Yeah, so I would say I really started to get into that probably 2018, so maybe 7 years ago. So I think what attracted me to it is it's very academic. And it's probably the area of the market where you have very intelligent investors. And I say that, coming from a legal background, it's one of the areas where you kind of have to study a little bit and really use your analytical thinking. The reason for that is it's not just the scientific that is somewhat interesting, but there's a very large part of regulatory arbitrage, potentially merger arbitrage. There's a lot of legalities in the space. And so combining both the advancement of technology with the legal framework that I find interesting made me dive more and more and more into it. And it's also just an area where, you know, uh, it's at the forefront of technology. Combining all those three together made me very, very interested into it. And as someone who likes to learn, in a similar vein of Munger, I would say it just captivated me a little more than other sectors.
Yeah, as someone who's partial to the old demutualization, government spin out, oddball assets, I can resonate very strongly with that. All right, so that's great. It's great getting a bit of an overview. Most people who are listening probably know my background anyway, but I have been working in tech, and Peter and I did a law degree, although in different countries, and I came to investing through my dad, who was a property developer and business person for a long time. All right, so we've got that kind of stuff out of the way. We'll get down to the juicy stuff that people wanted to know. We'll start with some of the market questions. It's been like a pretty weird year across
Hmm.
most opportunity sets that weren't AI adjacent or data center adjacent. It's been like some, interesting emerging markets stories that have played out. But like apart from that, it's been a very mixed bag. And it's obviously been a pretty poor year for quality. So I got some of my thoughts on that. But how do you, like a lot of the questions we got were like, why did quality stocks underperform this year? So what are your thoughts on that?
Yeah, I think it's interesting. I love to hear your thoughts. I think part of it is segment by segment. You might have, I think there might have been some multiple re-rating from the AI threat in certain industries, and it's very hard to disprove those narratives during the fact, right? Like it's always hindsight. So, if you take like a SPIGI, SPGI, you think, well, AI is not really a threat. Come on, like no one's going to replace the risk of outsourcing AI to rate their bonds BBB plus, and then that may come true, but the time to defend that narrative comes at the cost of your multiple going from 45 times EBITDA to 25 times. And I think you probably saw that across a lot of quality stocks, just sort of re-rating down. And I think the other shoe to fall in that space is the economy is not doing as well. So you had some companies that either missed on earnings or had some just trouble if they weren't involved in AI. If you look into some industrial companies or companies like Pool Corp as an example, they're more cyclical. I think again just brings down the multiple, brings down the valuation across the sectors. That's my theory. I mean, I think you can probably go sector by sector and stock by stock and find some reason. Um, yeah, I'm curious. I'm curious what your thoughts are because I sort of your expertise. I'm curious why you think they've underperformed this year.
I think broadly speaking, you're on the money, especially with the K-shaped economy type thing.
Yeah,
It's been like a lot of dispersion, like generally. Like I don't like to look from the top up, but it is striking that like half of GDP growth this year was sorry, nominal GDP growth in North America was at least somewhat related to the data center AI build out, which is like that's like an unbelievable statistic. Like it's such a narrow part of
yeah,
the economy, driving
yeah,
so much of the economic growth, and then um, you had business interruptions throughout the year, um, which have affected uh, some industries in an idiosyncratic manner. Like a lot of quote unquote high quality companies had have some level of government exposure. You could see that in company like the classic info services, financial services have been especially hit by that. Like Equifax and Gartner come to mind directly off the bat, and those are companies that were sort of like knocked down idiosyncratically through the pullback in government expenditure and like Doge's intervention in the federal government's procurement process. And so some of those things are like they might not persist. The government is going to want to go back and fund welfare. I mean, that's just where we're at. But like, taking back from some of those themes, a lot of the quote unquote high quality companies that I would follow just came into the year like pretty fully priced. FICO was $2,100 dollars per share or something like that. It's trading at 70 or 80 times earnings on a 12-month basis. Moody's and SPGI, like you mentioned, they were high 30s even, depending on where they exited. Like 2024 was a really good year for a lot of these companies
yeah,
in that like their underlying businesses were sort of full recovery mode from the pandemic and its fallout. And companies like Moody's, they were bouncing back from issuance declines, and the things that were happening in rates were bringing forward like shortening bond maturity. So the ratings had to be done at a greater pace. So all these kind of things was kind of like a perfect year. 2024 was like a perfect year for quality, where the businesses did well and the multiples did well. And then they hit this year and the multiples were very high. And then a lot of them have had, like things that weren't expected happened, like, Bill Pulte's,
yeah,
intervention in the FHFA and all that kind of thing. No one saw that coming. Yeah, like as, if things aren't perfect and expectations come down, then the multiple, all things being equal, the multiple is going to adjust to reflect those things. And they just had a lot of these things had very high multiples to begin with. And then like outside of like the very high quality, financial services and info services type stuff, the tariffs had an effect on
Yeah.
some of the high quality businesses and industrials. And there's been a whole bunch of different things. So yeah, it's been like a very strange market, really strange market. Cool. All right. So yeah, we talked about the quality stocks a little bit. I mentioned, some of the less quality businesses might have outperformed this year. And, I wouldn't want to call Mag 7 or whatever the data heavy, data center plays and stuff to be particularly low quality businesses, but it is true that the delta on their capital intensity has been going up. And I don't think anyone knows, how the returns are going to look from that spend. So do you think this was like, a bit of a mean reversion with, the good quality business doing well last year and then not doing so well this year? Or how do you think about the things that didn't do so?
Yeah, I think like this is one trend that I would pay attention to, or at least maybe put it on my watch list, which is over the last 40 years, you've had, I don't know if you read the book Capitalism Without Capital, where they talk about just structurally how businesses over the last 40 years have gotten better because of just tremendous amount of IP that's been developed in software and in other areas that have made them asset light. What I'm curious to see over the next 25 years is this trend of, we got to a point, is there a point where AI has made structurally capital heavy businesses, I like to call them atoms and molecules, more valuable than businesses that didn't need that much capital or were capital light? So if you look at, for example, I mentioned Moody's, SPGI, talk about Gartner, we talk about FactSet. These are businesses that have done Intuit, right? We unbelievably well over the last, you can even go back 40 years, 30 years, 20 years. And a lot of it has just been high gross margin, high returns on capital. Really, the only thing you would see on the balance sheet is like goodwill. But has AI kind of said, well, I don't know if AI can replace a FactSet or Moody's or Gartner, whoever, but it sure raises the question, and it may be a legitimate question. And so until you disprove that, your multiple really comes down. But one thing I can't tell you is I can't really replace a drug that has a molecule concoction, or mining companies, or energy, oil and gas, which are chemicals. And maybe in some of those areas, the things that aren't bits and zeros, like ones and zeros or bits, the things that are atoms and molecules, maybe there's some industries there that have the AI tailwind and therefore become actually better businesses. And typically those companies that are, or industries that are in, I like to call atoms and molecules, they are also somewhat prone to regulation. So you think of rails, waste management, you think of chemical businesses, you think of biotechnology, you think of pharmaceutical companies. They're heavily regulated. And if you go down a list of those companies, of that industries or sectors, they're also quite beneficiaries of AI. So maybe there's a trend where, and again, I would put this more on the watch list. I have no way of proving this, but has that narrative shifted where these businesses are getting a more of a re-rating up, and then the businesses that are capital light getting a re-rating down until further notice? So I that's one thing I would want to pay attention to. Well, again, I can't disprove it, but it's just, I think it's one thing that I find interesting about the whole AI phenomenon, whereby you know, our returns for some of these companies that historically were garnered as poor businesses, maybe are higher than some of the things that have been capitalized. I'm curious what your thoughts are. I kind of just have that in the back of my mind, but I'm curious how you see it.
I agree a little bit, especially in the mean reversion of, like historically, like if you take like sort of like a run of the mill legacy software company that's been dominant for 10 plus years, it's like complete historical oddity, right? A
Yeah.
lot of these businesses just had like 80-90% gross margins. And yeah, they've had a lot of, like various varying levels of expenses, and, the accounting has been, again, traditional, asset heavy industry accounting wasn't made to like reconcile these companies very well, on an income statement. And so a lot of them have had like reported losses over the years. Like my general take on that theme is, probably for those type of companies, especially in software, there's, a lot of them are flagging gross margin headwinds
Right. Yeah.
as they go to implement these applications, like the compute that is necessary to do these higher end machine learning, AI, generative AI, whatever you want to call it, applications are, it's going to be a gross margin headwind to a lot of those kind of companies, which is, kind of makes sense from an economic perspective, right? Like you would think over time that, margins would revert, to some kind of historical norm as, more and more competition and the necessary nature to reinvest in your business happens. So I think that's kind of going to happen. I think the question is like, what happens below the gross margin? What's going to happen to your operating and net income margin? And like the companies that actually have the pricing power, they might replicate what Google or Alphabet did, in the 20s, which is
Mm-hmm.
they exited the 2000s, right, with 60 or 70% gross margins. And then, and obviously there's a lot more to, search is like kind of like the first company that really needed to implement machine learning and AI like at massive
Mm-hmm.
scale, right? They're kind of like the first company to do it. And then obviously they went into a whole bunch of other business lines, and those are
Yeah.
naturally more capital intensive and have lower gross margins. So I accept that. But they kind of went through this, big decade plus long investment cycle. And they came out the other end where, during that period, their operating margins were able to sort of improve. And now you see on the back end now, like their gross margins are improving. So maybe like the best asset light companies will have an investment phase and then they'll exit on the other end, like what you were saying.
Mm-hmm.
And they'll have maybe even a better margin structure on the other end
Mm-hmm.
if their market position is still what it is. And maybe that investment cycle will have to last. It won't have to last as long, because Google and Amazon and OpenAI, blah, blah, all these companies have, made a lot of these investments in the models and applications and stuff already. So maybe that will be like a shallower dip. And then in the more industrial,
Yeah.
it's unclear, but I suspect, like some of it is like every single downturn that we've had since the global financial crisis, even before, starting from the early 2000s, there's been like a structural loss of employment every time we've gone through a readjustment in the economy. And so maybe this is just like, this is just another one. These companies will be a lot more efficient on the back end. I think like one of the big questions, right, is that I'm not special in this, but I am starting to think like how sustainable are the investments that are being made by, Mag 7 and the AI model companies more specifically, especially now that, like Facebook's, tapped the corporate debt market to fund some of this stuff.
Yeah.
And, generally like their free cash flow margins across the board have really taken a hit from this stuff. So I don't know if you've got any thoughts, like if the money's going to run out soon or like how long this is going to go on for.
That is way above my pay grade, but I would caution, like
Yeah.
you have conversations of, hey, you are putting data centers in space. What happens if all these guys all of a sudden said like, oh, by the way, all those investments we made on the land, yeah, that was a mistake. Actually, space is the right answer, and we got to invest, I don't know, $1 trillion more in space. I just don't know where this goes and whether these investments eventually become highly depreciable and have really impact cash flow for quite some time. I don't have an answer to it. And also structurally, back to my original point, I think some of these lower quality businesses, some of them might have also garnered over earning due to data center build out, due to, cooling and other demands. So I think that's a big question mark. And again, that's what these questions are above my pay grade. I would consider these questions as something to just watch and see if they play out. It's very difficult to predict.
Bummer. I was hoping you were going to answer the $100 billion question. We'll have to wait till next year, I suppose.
Yeah.
Okay, we've got a question here, which was XBI, which I believe is that's the S&P 500 biotech life sciences ETF.
Oh, the biotech index, yeah.
Biotech index, excuse me, biotech index. It did well this year. Do you have any insights on why that did well?
Typically, XBI does well when interest rates are falling, right? Like they don't have to go to zero, but if they are coming from an elevated point and they are starting to come down or at least level off, there is some gains there. XBI did the exact same thing in 2007-6 when Greenspan started cutting slowly and really started to you'll see some weakness in the market. So typically XBI does well when the market and the employment's, when I say market, I mean the real economy is weakening, when rates are going down. It is an interest rate proxy. You also have the benefit of a good, I would say, scientific data from a number of companies. You had a little bit of an uptick in M&A. I think what's interesting is pharma has, if you think big tech and the Mag 7 have cash, these guys have a tremendous amount of cash. I mean, I think it's got to be close to $2 trillion. And knowing them, they're going to buy when valuations are much higher. I don't know why they didn't buy earlier, but they're probably going to buy uh, peak valuations. That's what they do. So I think it's a combination of those factors where it's biotech is a little, as much as it's volatile, there is a defensive element to it because it is an industry where you're dealing with people's lives. You're dealing with life-saving therapeutics. So, it's typically defensive, but more so than anything, they're also interest rate proxy. So as interest rates come down, weakening economy, and you had decent data across a variety of companies, plus some M&A, it bodes well for the XBI.
Makes sense. Okay, we've got a few questions here about how the index is going to do over the next 5 years. I have no idea.
Yeah,
You have any
I
insights
don't
on
know.
where Spruce is going to be?
Yeah, I honestly like it. I think I I don't think it'll be that great. Let's put it that way. I think probably, can I say under 10% CAGR? If I was to make that bet, I'd probably be under. Would it be higher in 5 years? Probably. Would it be spectacular? I don't think so. That's sort of my bet. But again, anything can happen.
Anything can happen. Yeah, I wouldn't have seen, I wouldn't have been able to predict ex ante what happened this year. So I won't pretend to
Right.
know how that's going to happen over the next 5 years. It seems very
Yeah.
tied to like how the data center stuff, because if
Yeah, for sure.
the market starts demanding a higher cost for this kind of stuff, and it has to go in reverse, like a lot of the similar themes happened in 2021, where interest rates are up and the market started demanding that your company actually be profitable, God forbid. And that was like a 20 or 30% correction. So
Yeah.
feels like, how long can you keep dancing for, and could keep dancing for 5 years? I don't know. I wouldn't want to bet on that though, if you know what I mean.
Yeah, for sure.
Okay, cool. We'll move on to the investing questions. So, all right. Well, yet a couple of spectacular winners, especially in the biotech space. How did the portfolio go otherwise in 2025?
It was pretty good. I can't complain. Like you said, it's been a strong year for a lot of the names that I've had. I think some picks earlier in the year are taking longer. I wouldn't have sized it as big. This might lead to the next question. I typically size my portfolio, or PA, let's say, would be much more concentrated, and it would be much more compounder focused with a sleeve of biotechs, and those compounders happen to be life science companies. Um, Generally, those areas did well, but it was volatile. Let's put it that way. There are periods you're like, holy cow, like there was some serious movement. So yeah, I can't complain too much about 2025. But there was a long stretch where you're like pulling out your hair. In this space, you have to have a very strong stomach to handle the volatility. So fortunately, I have that. But yeah, it was certainly a volatile period.
I concur. Very volatile year. Frustrating. I don't know if it was a frustrating year, but it's a lot of what do you want to call it? Like a poor return on brain damage here,
Yeah,
um,
yeah, yeah,
if you will.
yeah.
Hopefully that doesn't continue next year, but who knows? We'll talk about next year. I think we kind of rolled a little bit of this question into the last one, but there was one about how you invest, how you approach the investing question specifically, and how do you go about selecting securities and what are you looking for. I think from our conversations before, it sounds like you run a bit of like a segmented portfolio, right? Where there's like, or maybe what you might call like a barbell, and a section of the portfolio are more steady companies, and then there's some more interesting situations around the sides. Am I right there, or is that a little bit
Yeah, I
off?
would say that uh I press pretty hard on, I like to call them compounders. And what that just means for me is gross margins going up, our gross profits growing up, our revenues growing up, cash flow going up, and can you do it for a really long time, right? For me, it would be like a ClearPoint Neuro would be a compounder. I mean, it's a very volatile compounder, but it's like revenue go up every year. I have a very significant position in Twist Bioscience right now. Again, revenue goes up every year. Might be hits and stops. Maybe growth's not going to be smooth, but those kinds of situations, I have no problem pressing very large and putting that a significant percentage of the portfolio. The stuff that's a bit more sleeve-esque, I would call it, or sort of like a sliver, or biotechs. These are companies that are making drugs. And in that segment, there's a number of situations. My favorite situations are regulatory arbitrage or legal arbitrage situations. So an example would be nothing wrong with the drug, it works, but for whatever reason, maybe because of an audit, maybe because of the FDA doesn't like how manufacturing facilities do going, or maybe there's a controversial element to the trial. They find the application insufficient, right? So the stock drops and lingers there for some time, or maybe it goes to cash. There are some companies where, if I want to just go more scientific, it may be a situation where um, the science is compelling. There's no standard of care. There's no alternative uh, drug on the market, and the population is incredibly vulnerable. Like there's nothing for these people, and they die. So in those situations, okay, we could size a little bit of it. And there's the final segment in that the bio sleeve would be companies that are a bit more established. They do have revenues, they do have drugs. They're just expanding the platform a little more with the same technology. Those are the three areas that I typically try to invest across in the biotech sleeve, the bio sleeve, I call it. But the majority would be in sort of I would like to call compounder-esque life science companies.
This is one that I specifically have for you, but there's been like it's been like quite a bit of, well, inherently there's like a lot of positive, there can be positive volatility and also negative volatility in the space, and maybe this has been like quite a dispersed year in that regard. So generally speaking, how do you deal with the the volatility in some of this opportunity set?
It just depends what the volatility is. So if it's something like earnings, if I always invest in if I'm segmenting my portfolio, okay, the majority's in these compounder life science companies. I have a target in mind of what I think intrinsic value is over, let's say, a 3-year period. And so within that 3-year period, earnings are not going to always be smooth, but you hope they are. And there might be situations, whether it's macro, whether it's their fault or not, that is going to create volatility. I'm not so concerned about the minutia there. Like that does not bother me. I can handle a punch to the stomach. If you do not have a strong stomach, do not invest in the space. Like that's not the number one lesson. The things that I think are a bit more difficult or that I try to avoid, the ones I'm less tolerant of are, accounting frauds or things of, hey, the drug is a complete failure, right? Like I try my best to really avoid those situations. If you look at biotech, I'm going to exclude life science because again, they're a bit more compounder companies. But if you talk about biotechs, the companies that make molecules and drugs, there is an element of, does this thing work? And for you have to say no a lot to a lot of companies, and you also have to sort of spread your bets a little bit more. So you're going to have volatility within that space, no doubt about it. And I've seen in 70, 80% drawdowns. I think what keeps me sane there is just knowing what I have and then looking out 2, 3 years, like, okay, what does this picture look like over this period of time? I've also been fortunate enough to wire in in a very, very focused way. I have a very strong network of high-level fund managers or people that are incredibly smart, and I get to have conversations, and I am able to gauge what volatility that I'm willing to deal with. And so if I'm not comfortable after doing my due diligence on a particular name, then I will just avoid it. And if I'm into something that I have very high confidence in and I've done the diligence in and I believe it's a very good opportunity, the intermediate volatility doesn't bother me just because I know how that exit looks like. And for me, the way I invest is I have an entry multiple and then I have an exit multiple. And sometimes that exit multiple can come very, very far down the line. Sometimes it may never come down the line if I think I'm truly something special in the life science sector. But I typically try to, fulfill that goal or that price target or that intrinsic value and ignore the volatility. I hope that kind of answered the question.
Yeah, yeah, no, it's good. Yeah, because it can go both ways, right? Like you can have stuff that's up like 100% in a day, and also the big drawdowns you're talking about. This is like kind of these questions have been helpful for me this year because um, usually I'm not exposed to things that will move as dramatically like that, but quite a few of them have moved in a very
Yeah,
dramatic fashion this year. And yeah, it's a little bit more, it's a bit different on the compounder side, right? Because you're trying to
it
figure
is.
out,
Yeah,
is it impaired permanently? And especially like, yeah, you're big into the regulatory stuff, so you'll know. But, when you are dealing with rapidly changing regulatory environments, which can have, potentially big changes to vols and pricing, it's not easy to
yeah,
make decisions. I think if I've learned anything this year, it's I don't know if you ever heard of like the 3-day rule, but you don't like if there's a big news or announcement or something like that, don't try and make any big buy or sell decision within like the day of or a couple of days after, and give yourself a little bit of time to properly analyze actually what's going on outside of your reptilian brain telling you to run or buy more even
yeah.
some of those things.
I think what's
So
the risk with the compounders that I try to be very cognizant of is sort of the dead money syndrome, where you can have a compounder that is just, earnings are going up. There's a very low chance of it going to zero, like a capital impairment in that respect, but there might be a shot at dead money for a long time. And there's nothing wrong with the business. It's a great business, but you will never know whether you paid too high a price until it's hindsight. And I think that is one thing I'm cognizant of. So what's helped me with some of the compounders is obviously the price. I'd like to buy things when they are incredibly cheap. And I have like a scorecard of what exactly I would pay for a med tech company or a life science tools company or a bioprocessing company. They all have different multiples. They all have different because of their value within the healthcare ecosystem. I know kind of what terminal value is for each one of those. And so if I see something trading optically very odd, it's something I will pick up and say, okay, let me dive into my due diligence to see if there's an inflecting income statement. And that's one thing I've tried my best to learn. And you could tell that in the charts where something's been languishing for a few years and it's gotten just incredibly cheap. And then you dive a little deeper and you're like, wow, this thing's inflecting. It's about to inflect. I've gotten very good now at um, identifying those situations, and a lot of that has not only looking at reading information that's publicly available, but I do have a lot of conversations with people. As I've gotten older and as I've accumulated more capital, as I like to say, I've gone on far more calls and met way more people and have talked up to a lot more people than I have ever had. And that's really helped me gain a lot of confidence in a lot of the due diligence that I have done before, and that allows me to handle volatility a lot better. So if I can give you an example, so if I look at a company that has a 3-year chart that's been very flat, the multiples just gotten unbelievably compressed, but it's still growing quite rapidly. And you can tell that a company's found religion, right? They've cut a lot of capex, they've cut a lot of opex, the market demanded it. It's got a lot of short interest, short pressure. Like, okay, there's something here that's interesting, right? There's a lot of pressure on the stock. Maybe I'll talk to a relationship that I know to pod. Maybe I'll talk to some large fund managers. Maybe I'll go to a biotech conference, a life science conference. Let me talk to some customers. Let me get on the ground and see what's going on top of the sort of third party, third element research that I would do on, reading reports and looking at the balance sheet, income statement, et cetera, et cetera, on top of having calls with management. And then there's a sort of feeling, it's like that scene out of The Big Short where they're walking out of Vegas and they're like, yeah, it's a bubble. I sometimes have the inverse of that, which is, yeah, this is going to inflect, right? And so if you kind of have that feeling and you're able, especially in the life science space where it's a bit more, there's a lot more catalysts in that space. You can get a sense of the channel checks. You can get a sense of the catalyst. The near term, intermediate volatility really doesn't bother me. So that's how I've been able to handle it a lot. If I was going a bit more blind, and by blind I meant like I did not have a relationship, I wasn't on the ground, I'm not really talking to customers, I don't really see the trend, I don't really see what's secular, I don't get that feeling that is confirming my third party research, then it becomes a I think the volatility becomes a little harder because you feel a bit like you're going blind, but even though you're not really. So that's how I've certainly helped to do that, like handle the volatility. But again, it's hard for a lot of people to do, especially if you have a day job or if you're more retail focused. It's very difficult to have these conversations or to have that network. So I can see how it can certainly impact volatility, but that certainly also helped me a lot.
It's interesting, right? Because they talk about the capital cycle in the economy generally, but these capital cycles happen in companies, like
That's
what
right.
you're mentioning. You're like they're changing costs of debt, changing cost of equity over time, and different
That's right.
management remuneration structures over time. And when those things, they can line up nicely, right? The equity gets cheap. It makes their, the opportunity cost for their excess capital, if they're producing it, can become, they have different opportunities to move the needle. And then if you come in and have a properly incentivized management team, you can, really, really, really good things can happen. I see this more, with companies that are coming to market in like the kind of old, Greenblatt fashion where, they weren't run very well as public companies as private companies for whatever reason. And when they come to market, they're run just much better.
Mhm.
And both of those things, like, a good company that's lost its way, that's, going to turn the corner, like you're talking about. And then the other situations, it's like, that's like a very repeatable edge over time, especially in like the compoundery type stuff.
Yeah, for sure. And if you can help identify catalysts, that would also help as well. And that could be negative or positive. So sometimes you want to wait after the catalyst has occurred, or sometimes you want to get in before. I'm never someone to time things perfectly. Like that's not my forte, but I'm pretty good identifying, okay, here's a range of price that I think is cheap. Now, whether I'm like 3 months early, 4, 5, 6 months early is irrelevant. I'd rather be early than late in this space or just inside investing in general. But I'm always looking for incoming violence. I'm looking for an inflection. That inflection can occur it's usually multiple re-rate plus earnings growth, like inflection, like a significant earnings growth. And hopefully those two happen over a long duration period. The hard part is getting the confidence interval that that violence or that inflection is going to occur sooner rather than later. That's the difficult piece.
I could scarcely agree more. It's very funny, even in companies that you've followed for like a long time, there are
Yeah.
like particular moments where, like the confidence hurt, like you probably experienced, but like, your confidence hurdle might go up or down. And generally what I've found is that the confidence hurdle is not necessarily attached to like where the price is or if it's, historically cheap or something like that. You know what I mean? Like if you're following the companies very closely and like you're saying, you're doing the channel checks and you're talking to other smart investors who follow the company, you can have like these very idiosyncratic moments in time when something really is changing. And at the same time, you can be confident about that change. Because quite often there are changes that happen that, you didn't see coming, not many other people saw coming. But then there are moments in time where like as Buffett would say, the ball is in the 300 zone or the 500 zone. You know what
Yeah,
I mean? Like
that's right.
it's in your circle.
Yeah, there's a feeling I get where, and I'll text some friends where like it's go time, and usually when I'm in that zone, that's when all chips go in. Like we're about to make this the biggest bet that we're gonna make. And I can't explain to you specifically what that moment entails, but I guess the best analogy is sort of that Big Short scene where they leave Vegas and they're like, yeah, it's short everything, right? I get that feeling after doing a lot of primary diligence. I won't usually say that until I've really dwelled over something for many, many weeks. Now, the difficulty is sometimes you find a price that is just so attractive where you sort of buy first, verify later. That is one thing I've gotten a little bit better at because sometimes you don't have that much time. Sometimes the price is there, like it's all aligned at one moment. And I've done that more often than not now, which is buy first, verify later. But that again, this is all to say that I've kind of combined all these factors, that moment that once I have that feeling, nothing is going to stop me. No volatility will ever bother me. I had one name where I felt that way. It's my current largest position. and it would drop 20% on earnings. It didn't bother me a lick. I ignored earnings. I didn't even pay attention to it. Right. So it did. I just had such unmovable confidence in where I thought this was going to go. I had the same thing with ClearPoint, right, where I was sort of pounding the table at like $5, $6, $7, whatever. I just had there was a sort of moment there where I just had unbelievable confidence in where this was going to go, and I still have that confidence. The issue sometimes you face is, well, sometimes it overshoots to, you said FICO 70 times earnings. What do you do then? And maybe we can talk about selling or getting out of an ideal later on, but the confidence is still there. And if I have the confidence, I'm not too worried about the volatility.
Well, I couldn't ask for a better segue, because the next question is, how do you decide to sell down or completely exit an idea?
Yeah, so it's in the biotech. So bios are like sardines. There's always another fish in the market, always. So once I have a price target or intrinsic value in mind, I don't care if it goes higher, I'm out. Like there's always another one. Okay. The sector's incredibly volatile. I know the space very well. I have no guilt, so to speak, of getting out of uh, an individual, I call them biotech, like a molecule maker. The life science companies are a bit harder because they can go on for a long time. Right? Like if you bought Intuitive Surgical, and that's more medtech, but if you bought Intuitive Surgical in 2005, probably had one of the greatest investments in the history of the market, right? So if you sold it after a triple or a double, you look like an idiot. That cost you quite a bit of capital going forward. So those I typically, again, have an intrinsic value in mind, that where I will sort of up the volume or lower the volume. Sometimes I may hold those companies forever. Like if I find a FICO-esque company in the life science sector, that's a position where, like, yeah, I have no problem holding on to this forever or for a very long time. But if there is sort of a violent inflection coming or a catalyst coming, I may overpress in the short term. Then that once that catalyst reaches, okay, it overshoots to 50 times earnings or 25 times sales. Okay, it's time to really dial it down. I may still have a position that I park in the safe that I just don't touch, but I typically will try to scale down as best as I can. So, but that's for the life science compounders, like the companies that sort of, again, grow earnings every year. And once you've done that once, you learn the behavior and the personality of the equity. You learn how it's traded across, quant funds and high frequency traders. You get a sense of what the chart's going to do. So you might revisit it at some point where you press again. But that's how I typically try to do it with the compounder. Again, I look at it from a opportunity cost perspective. If nothing fun ever happens above 20 times sales in med tech, life science land. And if it is that for a very long period of time, like an Intuitive Surgical, you got something special. But that's a unicorn. It's a special thing. So typically that's my rule, where it's okay, above a certain valuation, you have to take something off. It doesn't make any sense. And then there's also rules on the downside. So like anything, if I find a life science tools companies that is, terminal value for a life science tools company, it's about 5 times enterprise value to sales. That's like terminal. Growing low single digits to mid single digits, but for a long time. If something's below that and it's growing 20% a year and has very good gross margins and is profitable or about to be profitable and has a significant amount of tailwinds, okay, maybe press a little bit. But if that gets re-rated to 15 times, okay, dial it down a bit. I will try to move in and out based on specific rules that I have on the compounders. Like I said before, on the pure bios, I mean, when I say bio, I mean you are giving a drug to somebody. Yeah, I have no guilt exiting completely because, again, I only have a sliver of that in those individual.
Yeah, it's very interesting, the difference between some of the more short-term situations and the longer-term ones.
Yeah.
Yeah, obviously I don't do the same sort of biotech and life science, or the biotech stuff that you're deep into, but my rubric is just, so long as the management team is properly executing across the asset, I just hold on to it and try not to look at the valuation too much.
Yeah.
But that's swings and roundabouts, right? But it's like that with any strategy. It's just important to know what strategy you're executing, because you got to stand by it for a long period of time to do well, to get the returns. Okay, cool. All right, this was a good one, which I have thought about a lot, but more of a philosophical esoteric idea. It was if you had discarded any old ideas, adopted any new ones, and things that you knew at the start of 2025 that just weren't so at the end of 2025.
Discarded. Yeah, I think I guess we can just say what lesson learned during 2025. What I learned in 2025 is to really press into my core strengths and not veer too much away from that. I had some legacy positions in other industries like IT services, or I believe I had like a couple of industrial positions, and I'm not wired into those sectors as I am into life science. I don't have the relationships, I don't have the pulse that I do in those sectors. And ironically, those are the situations where volatility bothered me the most because I would not have that, my fingers on the game, so to speak. So even though something looked optically cheap, even though something looked like it's inflecting, I just didn't know when, for example, the last cut would come, right? Or the last, this is it. Now it's earnings are going to go up from here. I did not have that sense in certain sectors. So I think the big lesson for me was just you really got to press in what you have very high confidence interval in and really stick within the box that you are your core competency. That's really helped me a lot because not only do I am able to put a good amount of capital behind a high confidence interval idea, but I'm also able to understand like on any given day, I'm like, yeah, this sector right now is going to be down and Nasdaq's going to be up, or you get a sense for how the game is going to flesh out based on your knowledge of that sector. So I think that's one thing that's helped me. Now, this is not to say don't expand your horizons to learn about other sectors or, look at other opportunities across those areas, but I feel that I would have to, like I said, outsource analysts there or talk to another expert in that field to get more of a understanding of how that sector is, if that makes sense. So I guess that's the biggest lesson for 2025.
No, it makes perfect sense. I will answer this one just because several people have asked me the same question this year when we've been out to lunch. But several of the companies I owned have really hit the pricing lever quite hard
Mhm.
over let's say, the past 5 or 10 years, specifically the last 5 years. And several people have asked me, like, do you think companies that are like very aggressively raising prices on their customers, if that's not the best strategy, and if I think that that's like not an appropriate investment strategy going forward, and I don't. All I want to say is I don't think that's like you can't make a blanket assumption
Right.
across the board, and like the pricing thing, like I was discussing with a friend of mine, TransDigm versus Heiko. Like
Mhm.
the main, like a lot of people own both, or one or the other. Heiko seems to have a better reputation for making really good money, but not like exploiting their customers, quote unquote. Yeah, TransDigm's been in front of Congress on multiple occasions, having to explain
Right.
why their belt buckles cost, the same as you might be able to get for your child on the black market or something like that.
Yeah. Yeah. Yeah.
And I think the takeaway is like, yeah, you don't like you want to be involved in win-win-win scenarios, and if you can have a really good business without raising the price on customers, that's probably preferable to not. But at the same time, historically, like having these windows of opportunities where you really can maximize the economics of a product, and even with the sell-offs and whatever in hindsight, those have been fantastic opportunities. And there's like challenges coming for all businesses, irrespective of whether or not they're raising prices on their customers. Also say it's like very interesting that some of these companies that have gone through this cycle of regulatory intervention have somehow emerged even stronger on the other side, which I wouldn't have predicted ex ante. So if I have, yes, some of them have turned out to be even more, even in an even better situation on the other end of the regulatory interventions. So if I learned anything this year, which I was probably a lot lighter on than in previous years, it was how important management is, especially over a multi-year time frame.
Hmm.
If you're gonna own securities for like, 2, 3, 5, 10 years or longer, management's contribution is basically enormous. It may as well be the whole thing
Yeah.
because one,
Yeah.
they're making the capital allocation decisions, right? And I think I can't verify the stat, but I think over a 5 or 10 year period, 60% of the stockholder return is going to be in some way tied to the capital allocation decisions made by a management team during that period and probably even beforehand. And, like I think what's been very interesting over many years is, good management teams seem to like create a lot of unexpected value, which is where like a lot of these re-ratings come from, right? There's a current understanding of a company and the services and products it provides for stocks to do really, really well, or a business to do very well. Let's put it in that way. You will have to produce some kind of outcome that people aren't expecting. And I mean, that happens in both ways, right? If you have very low expectations and people do a decently good job, you can have a great outcome, and expectations are very high. And then you knock those out of the park, you'll also do quite well. And then on the other side, if expectations are high and you only produce a mediocre result, then results are going to be, expectations have to come down to follow that.
Yeah.
So yeah, if I'm just struck by dispersion in my portfolio when you just basically just see how well management is executing against what they want to say. And it's a little bit hard, right? Because sometimes you have to make these decisions when that's not clear. It might not
Yeah.
be entirely clear to you how good management is. Like you have a bit of an inkling. It's like, okay, they said they're going to do this and then they delivered this and that's really good. And, that looks good, but that's not to say that they'll stop. They might stop performing at some
Yeah.
point. Yeah. And so, yeah, you just got to follow the stories. And yeah, a lot of people get a lot of, and obviously you get a lot of utility out of talking to management in some of these spaces, which is fantastic. I think that can go the other way though. On occasion, like people get enamored with a management team, they get enamored with a narrative, and that narrative might not link up very closely with like, how they've actually performed in the past. And
Yeah.
there's
Yeah.
always people want to be optimistic, and when you meet like a great
Yeah.
manager, they're like a great salesman. So you're like, oh,
Yeah.
this guy's making me feel good. I have a good feeling about where this is going to go. Or and this is another one of my mistakes, but I get enamored with the asset. I'm like, oh, the asset's so good. It's amazing.
Yeah.
But the person running it has like, maligned incentives, or he's got a very different vision. He has different priorities than what, if you were running the business, you'd have different priorities to what they have, and have those because they might have for a variety of different reasons. But
Yeah.
like this would be so good if management wasn't wasting all the money and spending it on stuff that I don't know how it's going to pan out. So it's kind of been one of the things
It's
I've been
interesting. The
reflecting
one
on.
of the new category that I found in the talking to management is the scared management team. Especially when you're dealing with sectors that get bombed out frequently, like life science or biotech. I'll go into a meeting and you can tell that their IRR team and management are like scared to say the wrong thing. And part of that is their stock hasn't moved in 3, 4, 5 years. And despite the fact that they've been performing pretty well, and despite the fact that they found religion on cost, they found religion on their science projects, they've done everything they can, and still stock still has not moved. And they're so scared to say the wrong thing. And everything's kind of, I don't want to say scripted, but you could tell there's a rigidity there. And I find those situations actually, ironically, somewhat profitable, because it's oftentimes, especially if you have a good business, it could be a sign of, I don't want to say a bottom, but it could be of a sign of there's an opportunity here where there's a feeling of doom for them. And I think they might be closer to escaping that really bad period than not. I've also dealt with managements who are very, very solid, and they're solid no matter what, even they execute no matter what, even though their stock price in the crapper, they still continue to, have that same tone. But then I've also dealt with really, really bad management. I will say though that life science or med tech companies are masters at hiding price increases. Like Repligen is fantastic for doing this. They'll say, yeah, we modestly increased price by 7% for the first 6 months. Nothing crazy. We just saw a little extra cost increase in some of our raw materials, but don't worry. I think will be normalized by the end of the year. And then the next quarter comes, like, yeah, we did another 7% increase. We're starting to see a little bit of a supply shock. We're seeing sort of low value for our customers, but they'll always come up with some kind of excuse or upgrade or innovation or supply constraint or something. Next thing you know, you got like 7% the first 6 months, 7% the next quarter, 3% the next quarter. Next thing you know, they jacked up price like 25%, 30%. Or they have a new innovation. Like, we have this new innovation. Yeah, pricing's going to be about threefold, 200% increase in price. But it's a brand new innovation. It's going to save you time and money. It's a value add to the. So they're very good at finessing. And I wonder if that's because they're in a very regulated environment and they know when to press and on the price and take it off. West is very good at that. They're like, we just want to pass along 3% price, 3% plus CPI. And then they do that a couple times. But if you look at the cumulative effect of the price increases, it's like, holy cow, like there is some serious pricing power here. It's just not happening all at once. I think they're quite good at doing that to some degree. So
Yeah, I think the companies that have the great pricing power across industries don't necessarily want to talk about it a lot
yeah, that's right.
in public. And like you mentioned, the regulatory angle, I think that's very apt. They don't want to encourage the regulator to, start sniffing around.
Take a look at it. Yeah,
Yeah,
that's right.
and then they don't also want to advertise how great their business is to potential competitors. And they're like, we've got this incredible profit
That's right.
pool and we're just able to, unilaterally, and then next thing you know, 5 other people are trying to do the same thing. So, but like on the same vein, it is always interesting what companies want to, what they want to communicate through their IR channels, right? And then
Yes.
compare that to like what's actually happening. Because like quite
Correct.
quite often, even in a very simple business, like the corporate propaganda, or like even when they're not really, they're not doing anything dodgy or whatever, it's all just straightforward stuff. Quite often, there's a big gap in between, what the real story is and what they're saying, which is kind of like why we can write newsletters, right? Because people want to figure out what's really going on, and then it's and then you talk about the good management teams. It's always striking to me how the good management teams, the good managers are pretty straight up and down, right? Obviously, they're not going to tell you absolutely everything, right? They're not going to be
Yeah, that's
super
right.
candid, absurdly candid, but they are going to be candid. And then typically there's like a lot of consistency, right? Like what you're talking about in the execution. If things are going well, they're plodding along with their strategy. If things are going well, they're plodding along with their strategy. It's striking how often you see just like, consistent progress really, really adds up over the years. And then
Hmm.
the poor management teams are like kind of like the inverse of that, right? Like there's always like a new thing and, we're doing AI now. We've got agentic agents and we're
That's
doing
right.
e-commerce in the cloud and, all over the
That's
place.
right.
It's like very striking to me. Like, like if you take a company like FICO and you compare it against Equifax, and Equifax has their great verification business, which is fantastic. But
Hmm.
it's just kind of funny that, FICO turns up every year and they're just talking about the scores for the most part. And they got some fast growing parts of their software business, which they talk a little bit about. Every year it's just, yeah, we're making more and more progress on this main core business. It's great. And
Hmm.
then the Equifax guys are, we're in the cloud. Now we've got Equifax AI. I couldn't tell you what Equifax AI is, and I don't think they could tell you what it is either,
All right.
but they're bouncing
Yeah.
around and we've got applications in the cloud and we've got an international strategy. And just compare the stock prices over the last 10 years. Just
That's
compare
right.
them. Just compare them.
Yeah.
So yeah, that's been striking. All right, we'll move along to some of the newsletter specific questions. Okay, so you started writing back of the napkin bios this year. When did you
Hmm.
start and what prompted you to start writing?
I started around May. I think the precipice for me, I've been sort of bullish biotech since late 2022, 2023. And I just started seeing it just got on the depression and the multiple evaluation, despite the progress and many names that are larger or well known, even in the life science sector, which is a bit too much. There's a feeling in me like this is getting out of control and there's free money everywhere in the sector. I'm going to start writing about names. Like I just had a sort of, I call it like fed up moment where inside me, I get this feeling in my stomach where like, this is just getting stupid. That was the precipice for me to write. So from May to call it August, there was actually quite a few articles I wrote. Since then, there's been a lot of surge in the XBI and in biotech general. So the frequency just started coming down. But that was really the reason for writing it, and just to keep me honest and journal my thoughts to provide to the public. That was really the motivation for it. And it helps me to, I actually sometimes use it, or oftentimes I use it as a source to go back, like, let me revisit what did I write about this like a month ago? It allows me to revisit the name as well. So it's been a benefit for both, just to say, hey, there are some incredibly cheap assets out there, but also as a way to revisit the thesis that I thought was interesting.
I think it definitely, on your point, it really does. I don't know if you find this, but I get, there's like this saying, you write to find out what you think. You don't
Yes.
think
Yes.
beforehand about, and I found
Yeah.
that to be very, very true, and very true, and very helpful to sort of translate the glob of whatever information swirling around in your subconscious and translate that into insights or structured thoughts about the companies and situations that you're covering.
Yeah. That's right. I agree.
All right, so we've got a few more here. I know that you obviously run the LP and you are still in the legal field, and then you kind of do this as an accompaniment to your investing. Have been any challenges with writing the newsletter that you wouldn't have thought of before you started?
Challenges. Honestly, probably during the period of time I started writing, there was such a flood of ideas. I think keeping track of everything, and really trying to keep expectations set as well, where this is not meant to be a trading journal. I'm never going to tell anybody what to do on any particular position. I think that's been the greatest challenge, is just sort of just adjusting expectations of what this is and where this goes, and being very clear with the audience. I would say is probably the biggest challenge. Oftentimes, we probably get the same, where people have requests, hey, what do you think of this stock? I'm like, I have no idea. I don't know anything about this stock. So it's been a challenge of sort of navigating requests, but also of things that you might not know about, even though you have some expertise in. And at the same time, just managing expectations of what is the purpose of this blog. And the real purpose was time stamping actionable ideas. So if I publish something, it's in the buy range right now. If you went out and bought that today, that price that was published, there's no fault. Like that was the reason for it. And then in every single post, there's a price target of what I think is fair-ish, or what I feel would be back of my mind of where I would exit or at least try to scale out. That might change, but that's typically, again, back of the napkin. It's just the math that I've done. I think just having those expectations where, then maybe the stock continues to run higher than the price target. And like, well, why did I sell early? And so keeping that expectation where, hey, there's always another one out there. Right? These aren't like crown jewel compounders. You're not missing Amazon here in 2002. Like, don't worry. I think just keeping expectations of the audience has sort of been the most challenging, I would say.
Yeah, it's a very interesting business to be in, quote unquote. I think we're chatting a little bit about it yesterday, about like the scene and stuff like that, and yeah, it's like a bit interesting how things might pan out with AI and generated content and stuff like that.
Yeah.
Yeah, it'll be an interesting time. I'll answer this one as well, just because
Yeah.
I also write a Substack. And this year was a pretty good year for me in terms of running it as a business. But it's
Hmm.
been kind of like a mixed bag across the other people who I would kind of like group myself in with. And I think probably like the biggest change this year has just been like people who are writing on a full-time basis, and especially in compoundery tech, tech adjacent world, like the frequency of content has had to go up as like a lot more people have entered the space. Like Scuttleburb's writing his Scuttle Bits, and MBI is writing every day, I think. And Alex from the Science of Hitting, he's written, I think he writes, 3 times a fortnight, like a Sunday and
Wow.
a Wednesday, and then another Sunday, and then he takes the next Wednesday off, and then he does the same cycle
Wow.
after that. Yeah, and even I've been writing 6, sometimes 8 articles um, a month, but it's kind of like those guys are a lot more established than I am. And they've been, like FinTwit personalities a long time. And it's like, and Scuttleburb's been very open about this, where he's like, had been going sort of X growth for the last year, or maybe like flat growth, kind of as the pandemic uh, kind of waned off. And like he shared the other day, like he went back to more consistent subscriber growth since he's been writing on a more
Hmm.
regular, which is, yeah, it's all pretty interesting. It's kind of like, like the, I don't, the deep dive stuff has become, it's just been easier to get that info, right? Like you can, for a lot
Yes,
of
yeah, for sure.
big, yeah, for a lot of like big publicly traded companies, you can go on to Deep Research or Gemini or whatever, and it can provide you with a lot of info off the bat that would have taken you like hours and hours and hours to source beforehand. So that's kind of like, people have been moving more away from that kind of content, more towards like timely analysis of stuff that's just happening. Cause I think that's going to, like, just naturally, if some news stories just drop today about whatever company it is that you're following and it's big, it's going to be like way harder for an LLM to like have any kind of context around that, just because the existing content on that particular topic doesn't exist. And so that's kind of like,
Yeah.
Scuttleblurb, he's talking about, like Gartner when it was selling off, and I forget the one that he did more recently. Oh, like, like in the legacy payments companies, Fiserv, etc., that had that
Yeah.
big, cataclysmic thing. And like, as when I've spoken to people who are, more on the professional side of things, I would say my subscribers are heavily professional investors. They're more like, like when you talk to them about, stuff they've really enjoyed reading this year, not specifically my thing, but just in general, it's like, yeah, if they own X, Y, and Z stock in the portfolio and it's off 30% overnight, they need to know, you know what I mean? And so like, if
Yeah.
you are an author, you can provide some value by like having a very timely article explaining something and bringing them up to speed on it. Whereas, yeah, like the more explaining stuff, but it's a bit interesting. Like I've had sort of success. It's a bit, it's so hard to know which articles will do well ex ante. Like there's stuff that I thought would do great that didn't go anywhere. And there was stuff that I thought, oh, this is just like a bit of an interesting tidbit. I'll just publish it. And then that like, got retweeted a lot on Twitter for some bizarre reason.
Hmm. Hmm.
And so that stuff done well, but like it is striking that the best quote unquote converting articles I've had this year have been very timely. The biggest one was when FICO announced its model change. So
Hmm.
like, and that was like, like a massive down and up day. And it was on the front, it was like on the front of the Wall Street Journal that
Hmm.
they were having this big change, So it's like, yeah, if I've got any advice for anyone wanting to start a newsletter, it would be, you can have a lot of value explaining niche topics that, people are going to be sensitive to. But who knows, the whole game might change again next year, It's changed
Yeah,
every year so far.
I think the deep dives, I mean, it's different from my focus because for a lot of people, they're not in the space. Like life science biotech is way over generalist head
Yeah,
generally,
like the
right?
stuff you're doing is naturally very niche, right? And explaining it is
Yeah.
is is actually very value add. Like I think like if you've used like if you've used Microsoft before, you're gonna, you know what I mean? Like you're gonna know what
Yeah, that's
Microsoft is.
right.
But
Yeah,
if
yeah.
X, Y, and Z drug trial gets approved, yeah, like you might be one of like 3 guys on the planet that know what's going on.
Yeah, right. And or if I write about a more of a compounder-esque even life science company, Twist Bioscience, that's a much more of a, it's in Kathy Wood's Arc G, it's a bit more, it's in pod of knife fight land, I call it. It's in like 1 to 10 billion market cap. So people know about it, but it's still quite niche. Even then I'll write a primer, like a small primer, not even a big one. And it'll like people want to discover it. But I find that my frequency has really dropped since August. Like in September, I had one post, right? And I had quite a bit of views there. So it's almost, what I've noticed, I think, is the more actionable stuff, because you don't know when it's going to pop. I think people say, okay, if someone's writing about it and it's timely, it means I got to act on it now. And I think you might be seeing that a little bit with your interaction where something happened with FICO, something very timely. I think people need to know about it because it might lead to a decision. Maybe I need to sell FICO. Maybe I need to buy more, right? I think that is where a lot of value can come from the Substack. Or likewise, if you have a really baked idea, and maybe it's not a compounder, maybe it's an obscure classified portal in Austria, okay, that nobody kind of really follows. I think people might find that valuable too because it's like off the beaten path, et cetera, et cetera. One thing I do also try to balance is, if like, especially if I go international or if it's not US listed or European listed, is the returns have to be so much greater than what I would find in North American markets, just for the liquidity purposes, for the patience that people have, for like if something in Europe, or I don't know, call it the Indonesian stock market does 55% and something in the US does 40. People I think will say, okay, I don't care about the extra 15% or the 10%. I'm going to buy it because it's US, it's easy, it's liquid, blah, 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 blah. So yeah, that's one thing I do try to keep in mind is for the life science stuff, I might have updates, but usually it's here's this primer. This is why I think it's very interesting and it's inflecting right now. For the bios, it's one and done. There are no further updates. It's you buy now and that's it. And there's a price target. You can decide whether you want to sell it, but that's it. And if it's still languishing in this price, okay, you might want to add to it. Unless I post about it again, like I provide an update where like, hey, it's now time to re-enter, it's over. Like the ship has sailed. So I think we're, I think it's a little different than if someone's writing 3 times a week about a particular idea or update. In this world, it's very difficult to do that.
Yeah, makes a lot of sense. All right, wrapping up here. Any exciting plans for 2026? Any kind of direction that you want to take the writing in, or just kind of going along on the same road that you've already been going?
I think it'll be harder because I think biotech will have a decent year. And I think there'll be less ideas available unless there's a massive sell-off. I think there should be less ideas available from a biotech perspective. That being said, the area that I've noticed that has popped up a little more is regulatory arbitrage in the biotech space. So this could be a situation where, for whatever reason, the drug has had good data and it works and has gone through the phase 1, 2, 3 trials, and investors got all excited, but for whatever reason, the government steps in and screws around, right? Whether it's a clinical hold because of a manufacturing audit, or whether it's a submission issue or something related to they're not satisfied with this application. I think there might be more opportunities there in that area than people think. Oftentimes, too, you might get comparable assets. So, you might get a situation where a company has something for, call it, let's say, eye cancer or some ophthalmological or auditory reason or whatever, it doesn't matter. And there's a competing company that also is going through the same trials. And you're like, well, maybe the multiple has to converge. The valuations have to converge. So I think next year will be more arbitrage focused, where I think you'll see a bit more alpha there. I think biotech should do fairly well next year, but and we'll see whether or not I'll get more ideas on the more compoundery life science stuff. But it just feels that next year might be a little less of that free money zone that I found earlier in the year.
Well, now that you've said that, you're going to have lots of good opportunities next year.
That's
Yeah, it is. It is a little bit tough. Like you always have an inkling that you'll have good ideas, but never know when they'll pop up. Which is yeah, it's always a bit of a struggle trying
It's
to
funny. The
link that
last
up with the
15
newsletter.
years, one of the best periods in biotech was Trump's first administration. So if this administration, like this 4 years, happens to be anything even close to his first four, you're probably going to have one of the greatest biotech runs we've ever seen.
This is
So,
not
and
financial
this is
advice,
with
by the way.
This is not financial advice. And this is with this is with like a completely dysfunctional FDA. Like you have RFK Jr. at the head of the Health and Human Services, Health and Safety of the country, and then you have Macri at the FDA and Prasad, and they're very controversial or more controversial. There's been issues there. The worst usually under Democratic presidents or heavily blue swayed legislative arm, it becomes a problem for biotech, generally speaking, right? So, and I'm not, I don't know if that's a pattern. I don't know if that will continue, but you might get a rip your face off bull rally in biotech like we've never seen before. Akin to the late 90s. If that's the case, then it's like you missed the boat you should have bought when I published all those posts. But no, with all seriousness, like if that happens, you might get some dips. I don't think it'll be smooth. So you might get some dips. I just think the free money feeling that I had in May, June is probably gone.
You heard it here first. Go out and subscribe to Backup the Napkin Bios ASAP. Okay. All I'll say is that on that particular issue is that every year I've thought the opportunity is getting worse, but opportunities show up in weird spots. So try and keep our eyes peeled again next year because, something's bound to show up. But, I actually quite think I'm like halfway between the idea of thinking that, going back to the quality discussion we had at the start, that, like maybe we're, maybe we're in like a multi-year, expectation reset, especially in North America, for some of the quality stuff, especially the stuff that's going to have to make more of the AI, quote unquote AI investments. Although to be fair, like at the same time, if the AI application stuff goes out of fashion again, maybe these companies will bounce back to like, historical returns and historical margins, and we'll just continue on as usual. So we'll see.
Yeah, I wonder, especially in your field or specialty, I wonder if there's a lot of ideas actually. Just because, I mean, I don't know if I would do, I don't know I think Moody's and SPIG year down quite a bit. I think all those similar adjacent companies are taking a beating, but it feels like the IRRs across that spectrum are pretty good. Even if you think they go back kind of, I don't want to say pre-AI, but even normalized, it feels like there might be some opportunities for some ideas of like, hey guys, like Verisk Analytics looks okay here, or hey, FactSet looks okay here, or I don't know. I don't know what ideas would be, but it seems like some of these things, they're down so much. I wonder if there's an opportunity for like an actionable post at some point where like, hey, this is getting out of control.
Yeah, I think like a great opportunity for a lot of that specific type of company was like in the in the 2022 2023 timeframe,
Right.
and around that time a lot of them were like shedding the capital discipline theme was playing out. Like in late 2022, like you mentioned Verisk, like they spun off Wood Mackenzie and did a big share repo and had attempted to like streamline their operations. And then they just gone complete 180 on that
Right.
this year and decided to like start doing, borderline transformative M&A again. And
Right.
then,
Right.
Moody's kind of promised not to do any more MA, Moody's Analytics acquisitions. And they've been okay at that. They started, do something, some bolt-ons here and there. And they're actually going to spin out their mobility unit next year, which I think is a good thing. But at the same time, they've got like, two really good businesses, which are the indexes and the ratings. And then they've got another two segments, which are, they're doing things like buying, conference organizing outfits, you know what I mean? Like hosting live
Mm-hmm.
events and stuff. You know what I mean? So
Mm-hmm.
yeah, it's kind of, it's always like a mixed bag with some of these things, and the devil's always in the details, but it does feel like the theme that played out when the markets were down last time around was that like you guys have to get your act together, and then they did. And then the environment went back to, well, we're going to be a bit more forgiving of you if you don't, if you're not going to get your act together. And then some of them took the opportunity to like triple down on that. Like, we're just going to go straight back to what we were doing, before COVID, unabashedly. And so that's less interesting. Some of the stuff that's been knocked down by the federal government, like Gartner or even Equifax, those things, you probably have a little bit more confidence that they're going to, like the federal government will be back at some point on the old spending spigot, Republicans or Democrats,
Yeah.
not withholding. I mean, both of them are interested in spending more money at the end of the day.
Yeah.
There'll probably be some nice idiosyncratic things like around the corners. I just was watching CNBC this morning, and they're all talking about, like NASDAQ and NYSE are going to go to 24-hour trading.
Yeah, it's crazy.
That might be like a decent volume opportunity for some of their business, even though they're not as transactional as they used to be. So I think, yeah, I'm always optimistic. I think if there's anything I've tried to do a little bit more in the last couple of years, it's try to find something that looks like Moody's or that looks like NYSE or that looks like the CBOE.
Yeah.
And less well appreciated area, because it feels like, I could be wrong on this, Moody's have like 100 years of 10% revenue growth, which is unbelievable. It's probably at some point that they'll mean revert back there or even faster. And if they're growing top line at 10, then it means they're growing their net income at like 15 or something like that. But yeah, like some of these like more nebulous ideas like look like them, but they're elsewhere where they're less appreciated. All right. Well, I feel like that's a good a spot as any to wind this up. We're getting to almost an hour and 40 minutes. I feel like we could go on for another hour and 40 minutes talking smack.
Yeah.
But thanks for coming on, mate. This has been fantastic. Let's do it again next year.
For sure. Always a pleasure.
Thanks, mate.
Yeah, no worries.